There is this one event on October 10th of this year where crypto has changed completely. Many market makers got completely wiped out. Many people that tended to bet on rising prices of altcoins, they lost everything, and that changed the dynamics quite a bit. In this video, we're going to talk about what has changed. We're going to talk about why the altcoin market cap on average went down by 58% in the matter of a few hours to then very quickly recover again. What kind of changes did this do to the ecosystem? And why can a price wick for the entire crypto industry happen like this? The answer is, as so often, extreme events have to be explained by extreme measures. What happened is that more and more leverage built up in the system. Leverage through perpetual futures contracts. So that's derivative contracts. It's platforms that allow to bet on crypto prices without owning the cryptocurrency directly. The reason why somebody might do this is because transaction fees are low and because it's capital efficient, right? We can make a 10x return when the price only doubles. This here is the total value locked, or the capital, that's on one of those platforms. It's the largest decentralized perpetual futures trading platform. It's called Hyperliquid, and it topped out at a TVL of $6 billion. This is all just stable coins. So there was money bridged from Arbitrum to the Hyperliquid chain. But then October 10th has changed the trajectory of the market. Suddenly we see outflows. There's less bets now on the ecosystem. I've just made a video on the Luna token and have a look at the funding rates of Luna over time. On the 10th of October, all the longs got liquidated and suddenly it costs money to bet on falling prices of Luna. So the equilibrium has changed in the bets perpetual futures market. Have a look at the amount of bets across all cryptocurrencies up until the 10th of October. It tended to be at 15 billion again on Hyperliquid, then crashed in a few hours down to 6 billion. So all the longs got liquidated, a few shorts stayed in the market. We saw a quick recovery, but now we are back to all-time lows. This is open interest across all cryptocurrencies. The development for individual assets is slightly different. For example, this is Bitcoin that has already peaked in open interest in May of this year. Or have a look at Ethereum that peaked in open interest in August of this year. So there's much less speculation now on crypto assets. A lot of the inherent leverage has left the market. This year was a cleansing event. At least it seems like this on the face of it, right? When we just look at the leverage that's in the perpetual futures on Hyperliquid. But once we zoom out a little bit, unfortunately, the situation still doesn't look that great. Have a look at the Bitcoin open interest measured in BTC. Yes, we did see a decline on October 10th. That's this over here. We recovered pretty much 100%. Now we're back to the lows. But in the grand scheme of things, there's still much more leverage than when Bitcoin was just at 20 or 30K, right? At the beginning of the bull market. By the way, if you're enjoying this video so far, then feel free to give it a like. It will help to spread the word. It will tell the algorithm to show the video to more people. Thank you very much. We can also see how this cleansing event hasn't changed the kind of exchanges that got affected. Yes, a few small exchanges grew in relevance, but that's mainly the Aster protocol, not necessarily the 10th of October that changed the dynamics. Ideally, we want to buy when there is very little interest in an asset class. Ideally, we want to buy when there's very little leverage in an asset class. The problem is when we just look at the perpetual futures leverage on a few exchanges, this doesn't really give us the entire picture because there's also leverage in the options market. There's also leverage in the futures market in traditional finance. And unfortunately, that did not decrease over time. So there's still a lot of leverage in the system. And leverage equates to risk. Leverage equates to volatility. This is the liquidation volume over time on the long side, on the short side. It's much larger now than it used to be back in the bear market days. Have a look at the amount of bets on the derivatives in US dollars. Yes, this did go down since October 10th, but here we don't just have crypto related leverage. We've also got futures, we've also got options, we've also got options on the ETFs. And this red line over here, that shows us the amount of bets on crypto relative to the market cap in crypto. And that's close to all-time highs. It's higher now than it has been on the 10th of October. And the same is true if you measure the same numbers in BTC. Again, we are still going up in terms of leverage. This is not good. The degen trader on Hyperliquid got wrecked and is exiting, but traditional finance still continues to play the game. They did not get wrecked on the 10th of October. The fundamental problem is always cascaded deleveraging. So if party A has to sell because the price didn't go up that much anymore, party B has to potentially sell as well because the stop loss gets triggered. Party C has to then sell because they get a margin call. And so more and more selling leads to more and more additional selling. And that then led to the total value locked, the capital across all chains in decentralized finance, to fall from 180 billion all the way down to 40 billion. The question is, are we really going to rise that much higher compared to the peak in 2022? It's very hard to say how long the show will go on. It needs a big implosion, some kind of systemic collapse so that people stop moving capital into crypto, right? This was the Terra Luna collapse. That's when the stablecoin market cap went down. That's when Bitcoin moved from 69 to 16K. But then since October of 2023, we are expanding again. And it seems like we continue to expand. So it seems like the music is still playing. And the growth is quite significant. Over the last year, the stablecoin market cap appreciated by 53%. And it seems like the price of Bitcoin can appreciate even faster than the stablecoin market cap. Yes, it's more volatile, but when money flows into the system, that's of course good for crypto prices. And it seems like we continue to see those inflows for now. The situation does look dangerous. People take on more and more risk, especially coming from traditional finance. That's what's still supporting the prices. But once we see less money flowing into the space, this might also very quickly cascade down again. I'm wondering if in the next weeks we see potentially some kind of announcement. Maybe there was something systemic that blew up on the 10th of October that we haven't heard of yet. Why else are funding rates for so many cryptocurrencies not recovering anymore since the 10th of October? Something structurally has changed, despite money still flowing into the space, which supports prices. Now, this whole game can be as complex or as simple as we want. We can just dollar cost average into the market, just bet on long-term adoption, bet on long-term devaluation of money, and we are fine. We don't necessarily have to time the market. Or alternatively, we can make it very complex, as in we try to follow every single piece of news. We try to get an edge by being more informed than the average market participant. I think the best is a middle ground, trying to still time the market, but not just based on guesswork, based on mathematical approaches that used to work pretty well in the past. And so this is my favorite approach. It's following a technical indicator, the moving average, that historically worked the best. What we see over here, that's the 44-day simple moving average. And the strategy is very straightforward. We go long, we bet on rising prices whenever we are above that moving average, and we bet on falling prices whenever we are below that moving average. Now I've backtested all moving averages from the 2-day to the 200-day, and the 44-day is one of the best. And historically, this worked very well. Will it work in the future? Who knows? But at least over the last 10 years, it performed much better compared to just buying and holding. Buying and holding is the line here in white. Every horizontal line here, by the way, that's a 10x return. So this performance is more than 100x better than just buying and holding Bitcoin. Here's the same performance measured in BTC. And so that's then the potential alternative to just dollar cost averaging into Bitcoin, trying to ride the market. Now you can simply trade this yourself, right? You can just buy and sell whenever you're above or below the 44-day simple moving average. Or if you wanted to, you can also allocate towards that strategy directly. So that's part of the premium membership of this channel. The link is down below. It's thebitcoinstrader.com. A link to premium pops up here on the screen. It will lead you to the website. Thanks again for watching and see you next time. Cheers.